Howdy there, folks. Welcome into today's video. We got a buy one, get one free in this one here today. A little negative, little positive, okay? First video we're going to react to, we're heading toward a severe deflationary recession. So we're going to hear what this gentleman has to say, react to that, and kind of give my perspective on that one. And then we'll react to this one. BlackRock's Larry Fink says he doesn't expect a big recession in the United States. So we'll hear what Larry Fink has to say. I'll react to that, give my opinion. It's equal as all things should be in life. Thanks for being here, folks. 25,500 plus subscribers now at this point in time. I appreciate y'all. I just made my moves here today in the Patreon portfolio. If you want access to see all the stocks I'm buying, selling, and whatnot, then check out the pinned comment down there. Let's get straight into this.
McClone, Bloomberg Intelligence senior macro strategist. Mike, gold sitting above 2,000 an ounce. Is 2,000 the new support? And is it off to the races from here?
Yes and yes. Thanks for the easy question. I think it is. Pulling back a little today, but I think it's inevitable that gold gets above this $2,000 an ounce level. And never.
That's not a little, by the way. For gold, 2% is huge. If this is, I don't know, Tesla stock or Meta stock, 2% is nothing, okay? I'm telling you, gold, like 2% moves are big.
Looks back. And the key catalyst is the stock market potentially rolling over. And here's a big difference with gold compared to the stock market. I look at gold versus the S&P 500. It's very low on a 120-month basis. A 10-year basis is basically unchanged. The stock market total returns around 300% or so. Those are starting to reverse. And the big difference, the last time we did this was really around the start of the new millennium, was the Federal Reserve was well into an easing cycle. So I see this as just the catalyst for gold to take off. It's one of the few commodities I'm really bullish on because everything's starting to tilt downward towards deflationary trends.
Yeah, and we definitely have seen investors pouring into gold. Talk to us about what happens if the Fed doesn't pivot this year. I mean, what will happen to gold in that scenario?
By the way, so gold, simple as this, okay? If you want to know if gold's going to go up or down, okay? Massive fear and scared folks, especially in the banking system. When that happens, gold goes through a boom cycle. Look back at the great financial crisis and look what gold did from about 2008 through about 2011 or so, right? Once the fear starts dissipating, right, and the banking system was then in the clear again, and you stopped really seeing a lot of bank failures in 2012 and moving in future years, you look what happened to gold after that, right? And look what happened to the stock market after that. And so just understand, in order to get gold to continue to spike higher and a lot higher, you really need people to continue to be fearful, scared. But one of the other limiting factors, in my opinion, on gold, and this is more over a longer term perspective, is a lot of folks that are in the younger generation do not look at gold as gold. If they're going to look at something as gold, it is Bitcoin. And I know there's a lot of maybe older folks that might be watching this video right now that you're like, that's ridiculous. Like, you know, why these millennials, why they buy Bitcoin instead of gold? It's the way it is, okay? It's seen as digital gold. And so for a lot of people, especially in my generation, I'm 33 years old, right? A lot of people in my generation would much rather put their money, they feel like it's a safer place, it's going to give them a better ROI over the next 10, 20 years in Bitcoin than gold, okay? Take that for what it is, but it is what it is, okay? And so just do keep that in mind in regards to gold and excitement and if it's going to go higher or lower and things like that.
Markets will make them. I think that's the stage we are right now. The Fed will pivot when the market makes them, and the number one thing to make them pivot is probably the stock market going down, the S&P 500 dropping at a higher velocity. It's been hovering around this 4,000 level upper.
100%, 100%. That's exactly what I've been saying. I have a conspiracy theory. I'll tell you about my conspiracy theory in a second.
Down 200 points from that. And I think it's just inevitable at some point it tilts back down because the Fed's not going to ease, it looks like, until it doesn't. I mean, the jaw opening from the Fed governors is quite serious. They keep talking about higher rates, despite the data we've seen all this week. They're starting to get that trend of misses, misses on PPI, misses on retail sales. It's just, to me, part of what happens in a recession. I think that's the stage we're at right now. The markets are getting it. 2-note yields, 10-year notes are getting it, but the Fed is still being vigilant against inflation, which is collapsing. You look at PPI, I see PPI and then year-over-year basis heading towards negative by the time we get to July. And that's just what happens normally when commodities collapse.
And you have an interesting note about the relationship between crude oil and gold. So what do you see? Because most investors maybe aren't thinking that way. What do you see between that relationship and where gold can go?
That's interesting. So before we get into that, if you watch my content religiously, you know what I've been, my conspiracy theory I've been talking about here for a few months. My conspiracy theory has been that this summer, at some point in time, we might see S&P 500 drop 10 to 20% in a quick amount of time. And it would be in such a quick amount of time that it would cause a lot of fear in the market, panic in the Fed. Wall Street would force the Fed to essentially start cutting rates. And it's been my conspiracy theory, whether it happens or not, we'll see. But that's just like putting the pieces together, know how Wall Street loves to kind of play with the market and really, I've felt like the Fed's decisions and everybody's decisions is really based upon what Wall Street wants, what Wall Street gets. And Wall Street doesn't mind that the Fed's been raising rates because we got to kill down inflation or it's going to cause a decade of problems. And so, but once we start getting to that place, if the Fed's not moving and they're not getting ready to cut, Wall Street will force them to cut. And they will force them to cut by dropping the S&P 500 10 to 20% in a quick amount of time. And that will cause fear, panic. You add some bad employment numbers on top of that or something, other bad economic numbers, and boom, the Fed's ready to start cutting rates. They'll have every reason to do so at that point in time. Market would be tanking, right? Oh my gosh. And then all of a sudden you'd see a recovery once they start cutting those rates there, okay? And all of a sudden the market would kind of balance out. So anyways, that's kind of a little conspiracy theory I have. We'll see what plays out there. Might not, but that's just always been something I've just been thinking about.
The crude oil is an enduring bear market that had a bounce last year and tilting back towards that bear market aggressively. On a 12-month basis, it's down about 20%. $80 a barrel in this year's range has been between 65 and 85. And still it's the upper end of the range. I think it's going to go lower. And follow natural gas. Natural gas has dropped 80% from last year's peak. It's the number one measure of heat, electricity, and fertilizer this country. And it's at this cost of production, a price that first started trading in 1990. I think crude oil is going to do that and go towards 40. So basically, deflation in fossil fuels is encouraging inflation in gold. And I think that's just starting to kick in and accelerate. You see the end of the quarter, end of 1Q close in gold was the highest ever. It's just hovering around that $2,000 level. And the key question I ask is what stops this? The Fed is still tightening. Typically, when you have commodities collapsing at this velocity in the past, the Fed has already been easing, and they're still vigilant against that. So I see what we're doing is heading towards a severe deflationary recession, as indicated by commodities, by the Fed still tightening, the curve's significantly inverted, and now we have a pretty serious credit crisis going on with just pulling back of deposits from the major banks. That means it's just starting to get started. And the key thing I'll end with is that we were just looking at annualized industrial demand for natural gas in this country. It's the lowest in 6 years now. And that's an annualized basis, so it's not seasonal.
How do you think investors should buy gold? I mean, for people that are just looking at this gold rally, this recent gold rally and thinking, man, I want to get in on this. I mean, what is the best way? Is it through ETFs? Should they be buying physical gold? What do you say?
Well, that's the thing that ETFs made so much easier for people like me who used to, I was kind of afraid to buy physical gold before ETFs, so you buy equities. ETFs are such an easy way to do it. It's quite clear. But I think one thing that's going to be coincident with this gold rally is the rally we're having in U.S. long bonds and declining yields. So ETFs are just an easy way to express those views and investments.
And the miners?
Well, the history of miners, you have to be more selective. You can get those many X's of returns, but you have to be selective. The overall miners, like the GDX index, has a history of underperforming gold over time. The key reason for that is you just can't create more gold cost effectively like you can crude oil and a lot of other commodities. So overall, that physical ETFs that track gold have a history of outperforming indices like the GDX index, which is just an index of miners.
Mike McClone, Bloomberg Intelligence Senior Macro Strategist, thanks so much for talking to us about gold today.
Yes, thank you, sir. We do appreciate you. I was just checking over, seeing how gold's been kind of performing recently in regards to different assets. On a one-year basis, you look at something like Tesla, and it's amazing, right? Then you look at like year-to-date, and oh my gosh, what a different story there. So just kind of fascinating. But, I thought one last point I want to make based upon what he was just talking about there is he was basically talking about, commodities, don't usually see them go down this much this early. But also keep in mind, we just came off the most insane bullish commodity cycle we maybe have ever seen, or certainly one of the most insane bullish cycles we ever saw. I mean, from basically through 2021 through the first half of 2022, certainly in my lifetime, we've never seen that insane of a bullish cycle in commodities, where almost every single commodity went to the moon. Okay, it actually started in 2020 for a lot of commodities, specifically around summer of 2020. And so that's just one of those factors to look at, and you got to think, what did we come off of? The most insane, arguably the most insane bullish cycle we've ever seen in the history of commodities. Well, it makes that drop seem that much more significant. Like it's like basically what happened with commodities in terms of from the summer of 2020 through summer of 2022, right? That cycle was as insane, in my opinion, when it came to commodities as the tech bubble was to stock valuations. Let that sink in. And speaking about sink, let's listen to Larry Fink. Oh!
Counter argument to people like you who say that we're going to have sticky inflation for a really long time is that if we get a big recession, that does cure inflation. So are you saying that you're not expecting a big recession in the U.S.?
I am not expecting a big recession in the U.S. We have to offset that. We have 3 giant fiscal stimuluses that were created in the last 2 years.
Before he goes, I just got to say, I'm so into cosmetics nowadays between e.l.f. and Honest Stock that I noticed Sarah Eisen has been doing her makeup very differently. And her hair and everything like that, man, that's when you know you own too many cosmetic stocks.
So are you saying that you're not expecting a big recession in the U.S.?
I am not expecting a big recession in the U.S. We have to offset that. We have 3 giant fiscal stimuluses that were created in the last 2 years that are starting to enter our economy. That's the infrastructure bill. That's the CHIPS Act and the IRA. The culminated of those 3 bills are $1 trillion of stimulus over the next few years. Think about how many jobs infrastructure creates. Think about the demand for commodities as we build infrastructure. And so yes, you're right. We have some sectors of the economy are starting to weakening, but we are going to have other segments of the economy because these tremendous fiscal stimuluses are going to offset some of that. And that's just beginning. Those stimuluses are just beginning to enter the economy right now as other components are slowing down. So, no, I don't see a big recession. I'm not even sure we're going to have a recession in 2023. We may have it early 24. It really depends on what is the pathway of inflation.
This is hilarious because my mom's in town right now, right? And we were driving around Vegas last night, right? And she's like, oh my gosh, this whole city's under construction. Because it's true. Like you drive on almost every single highway around Vegas metropolitan area right now. It's like construction. And so, at the end of the day, a lot of those bills are either state funded, federal funded, and in terms of these big projects, and it produces a lot of work, right? And so it's one of those things I look at right now. If people lose their jobs, shoot, man, I can tell you there's going to be a lot of construction jobs with all the federal spending and state spending on infrastructure packages.
In the short run, what is the pathway of the Fed? And also, more importantly, how does this all play out in terms of credit and credit spreads? And what is that impact on regional banks and other asset owners?
Well, let's go back. 1 month ago, we'd sit here, and there were actually people who would come on and talk about the Republic being in danger, not Republic Bank.
The country, yes.
Now, how did we get to a point where a couple of banks failed and everyone suddenly felt that the system was as weak as it was in 2008?
Well, I think they were wrong. I mean, we have, yes, when you have a 475 basis point movement in 18 months of interest rates, you're going to expose risk takers who took too much risk. That is not systemic. We've had a few banks that had hyper asset growth in 2020 and 21. Those all you have to do is look at who had the hyper asset growth during 2020 and 2021. And so that means they took on a lot of mortgages at 3.5%. They took on a lot of assets at the lower interest rate. Now, the bigger question is not everybody who had hypergrowth then failed because they probably matched their assets and liabilities. But those who did not look at they made a lot of money because the interest, they were paying very low short rates and earning the 3 3/8. Well, now they're paying 5+% and earning 3 3/8. And so they have, that's the problem. But this is not a systemic problem. This is not a problem that is going to impact, as we saw today. We had our big banks having great quarters and performing really well. And so I think this is just an example of You know what?
Yeah, JP Morgan's earnings were incredible. That's a stock that's in my dividend account. It's the only bank I own. Their earnings were ridiculous. Everybody in the private stock group, in the private wealth group, check out the video in Breadcrumbs I posted today. That went super in depth in JP Morgan's earnings. I mean, wow, numbers were incredible. By the way, if you're looking to join us in there and you haven't joined in my private group and you're looking to apply, look in the description area. There'll be an application down there.
See, when the tide goes out, some people are going to be left there.
But Larry, there was one part of this that was distinctive, which was the rapid disappearance of deposits in a matter of hours.
Yeah.
42 billion. I've said this number many times in 4 hours.
Yes.
SVB. I assume that got your attention. I'm just curious as to whether you think it's sort of an existential question for some of these banks.
I think it's going to be a bigger existential question as what do banks do with their held to maturity account? Right. I think that's what the real issue is. We have this. The
only reason I'm laughing, and by the way, that's definitely a possibility. It's like the recession thing, man. It just keeps getting pushed out. It was like it's first half 2022, second half 2022, first half 2023, second half 2023. Now we're talking 2024. So it's just eventually, it's there, right? But it's just like, people keep pushing it. And then if it doesn't happen in early 2024, then people are going to say second half 2024. Then if it doesn't happen then, first half 2025, eventually it will be right. But it's hilarious.
Held to maturity more in this country than in most other countries. Actually, in most other countries, banks do more floating rate lending than fixed term lending. We're able to do more fixed term lending and put that into a held to maturity account. What we have seen, and we've never seen this before, is the market's looking through to the mark-to-market impairment, and they're saying, "Oh my gosh, this company may be impaired. And then we've never seen.
That is, what is that? That is like, what? Interesting.
Before is the market's looking through to the mark-to-market impairment, and they're saying, "Oh my gosh, this company may be impaired. And then you had the deposit flight,
and they fly a lot quicker than they used to.
So that's the bigger question: is what is the value of held to maturity? How should banks be using that? So does that mean the banking system is going to be more engaged in lending floating rate, less fixed? That to me is one of the big existential questions to ask. Does the transparency of held to maturity now mean we're going to see different outcomes with banks to minimize that outflow in liabilities? The outflow in liabilities is a great reminder that this money is overnight money. Okay, so it is a reminder, and seeing $42 billion out in 4 hours is a great reminder how quickly things can turn. The result will mean is more and more institutions will probably shorten their asset and liability match, making sure it's more matched. But does it beg the question is, how are they going to look at held to maturity going forward? And I think we have not spent enough time and asked ourselves that, what is the value of held to maturity if the capital markets are going to look through that and mark to market it? Right. Because for regulatory purposes, you don't have to mark to market it. And I think that was one of the big issues related to the supervisors of that institution.
Yeah, we talked about that.
Because it was an account that was a commonly accepted accounting rule that if you deem this asset to go into a held to maturity, that you don't have to mark to market it. But yet now the capital markets is now looking through that and saying, no, we want to know what's really going on in that one giant pool of money.
And you're right, capital markets. You use a great phrase here. You say this will further accelerate capital markets growth. This is happening, and it's not been recognized until I read this in your piece.
And that's my point. I mean, we have a backdrop. We have the most developed capital markets. We're sitting in the bastion of capitalism here at the New York Stock Exchange. We are benefited by having this robust capital markets. And so in actuality, very few people missed a beat during these failures because so much money had the ability to run from there and put their money safely. That's a good outcome. Now, the question is, though, from a BlackRock perspective, we need a healthy banking system and we need a healthy capital market system. Right. And that's what we need. We need a good mixture. But you're going to see when the one segment of that segment is in distress, like we saw, you're going to see more money flowing into the capital markets. And that may reverse one time, too. And so we do have the most healthy financial system of any country in the world, and we should be proud of it. We should not look at this with extreme negativity. We should look at this, my gosh, we had those safety valves, and it worked.
Yeah, great point. Right now, I wouldn't say the capital markets are very healthy. Reason for that, and reason I would say that is not because the indexes aren't doing fine, because they're doing fine. It's just one key piece of the health, okay? And I don't know if I want to call this the heart or the lungs of the stock market, of capital markets, but it is companies going public. And companies going public is non-existent right now. Like, look out there, try to find an IPO right now. Try to find a SPAC right now. Like, those things are just non-existent and have been non-existent for honestly over a year now. We've been in a drought for over a year in terms of SPACs, IPOs, any of that activity, right? Like, no company's pretty much going public. It's amazing, right? And I don't honestly see that being fixed in the short term. I mean, maybe if we can have a strengthening market into summer, and let's say we don't have any sort of sell-off in the summer, then maybe I think some more companies will consider IPOs or SPACs, but really like traditional IPOs, I think is going to be their route kind of in the future moving here. Maybe they can start to consider some of those in the very end of this year or at some point in the first half of 2024. But that's a real sign that I think everybody should look at to know if our capital markets are really in a healthy place or not. Is when somebody that has a private company says, I'm going to take that company public, because no one wants to do that right now. Because let's be honest, there's no risk appetite for any company that's a money loser, which is a significant amount of companies that are private companies, right? And even if you're a money maker, you better be making a lot of money. Because if you're making a little bit of money and you want a big valuation, that's not happening in this market, folks. That's not happening at all. And so actually one of the best things going for other stocks in the market, big tech and the rest of the S&P 500, NASDAQ 100, and a lot of stocks, is the fact that those new companies coming to market aren't stealing away money. Because think about it. Imagine there's some exciting company going IPO, right? Imagine you have a $100,000 portfolio and you're like, I want to put $10,000 in this company that's about to go public. So you go and you sell $10,000 worth of Apple stock, right? You're like, I got 20,000 Apple, I'm going to take 10,000 out, put it in this new IPO. That happens across the stock market all the time when you have a bunch of companies going public. And the bigger the companies are, the more money they take from other stocks are allocated toward those other companies, right? When Meta went public, when Alibaba went public, when Uber went public, when a lot of these massive companies, you can call them tech unicorns with huge valuations, went public, they stole money, basically, away from other stocks because people need money to put in those new stocks, so they take it out of old stocks, right? We don't have any competition right now. So the old traditional stocks that are already in the market are basically just competing with themselves. They're not competing with the new giant corporation that just went public. And that's a very different dynamic than we had from about 2011 to 2021. Because 2011, 2021, we had an insane amount of IPOs. Companies go public, right? And then you had the direct listings, the SPACs, everything like that, right? Which was a whole other level on top of that. So appreciate everybody joining me as always. Thanks for being subscribed, folks. 25,500 subscribers now at this point in time. Make sure you join us in the Patreon. See all the moves I was up to here today. That's pinned comment down there. If you're looking to apply for my private group, that's going to be in the description area for an application. And have a great day.